Good afternoon. Thank you for joining our discussion today on today's current environment and rapidly changing landscape in retirement policy. Before my time here at NTU and Capitol Hill, I spent over a decade at the Social Security Administration, where I got to know a couple of today's panelists. One thing I realized over there was just how partisan the policy debate on Social Security has become, particularly on solvency. Luckily, the other two legs of the so-called retirement income stool, like the three-legged stool, pensions and personal savings, is much more bipartisan. It was a relief for me and sort of a revelation. Democrats and Republicans work together on these issues all the time. As a result, there's been a lot of progress in retirement policy as of late. Automatic enrollment, increase in the RMD age, access to plans for part-time workers, enhanced catch-up limits, and so on. But there's still a lot more work to do. While access to plans have increased for many Americans, there are still a lot of people out there without savings outside of Social Security. And Social Security was never meant to take care of everyone's retirement needs. Plans can be complicated with options that come with some risk without good decision making. On the other hand, plan sponsors face unnecessary litigation risk if they try to innovate and create programs that might increase returns for investors. There's also the potential for new mandated retirement programs that can create unnecessarily risk, higher costs and lower investment returns for Americans. So there's a lot of opportunity out there for some good policy innovation. The Trump administration has created several programs to help improve retirement security for Americans, including Trump accounts and Trump IRA. We'll talk more about these today. We'll also talk about implementation of Secure 2.0, the most recent bipartisan retirement legislation that passed in 2022, as well as provisions being considered in a possible Secure 3.0. We'll also close the broader discussion of the retirement policy landscape, focusing on ways to improve options and expand access while being sure that taxpayers are being protected along the way. Tax subsidies for retirement benefits represent one of the largest tax expenditures in the federal budget. It is a question whether taxpayers are getting the best bang for their buck in this policy area. Let me begin by introducing our three esteemed panelists. Michael Davis is president of MLD Advisory Group, a retirement fiduciary and policy-focused firm. Mr. Davis has over 34 years of experience across retirement strategy, investment management, investment banking, and U.S. retirement policy. Most recently as head of global retirement strategy at T. Rowe Price, a global investment company where over two-thirds of the firm's $1.9 trillion under management was retirement related. Previously, he served as Deputy Assistant Secretary at DOL's EBSA, Employment Benefits Security Administration. EBSA oversees over 800,000 private retirement plans, 2.8 million health plans, and over 500,000 welfare benefit plans, which collectively hold over 15 trillion in assets. He has also previously held senior positions at JP Morgan and Prudential. Michael also enjoys reading presidential biographies, travel, and spending time with his family. Michael Sinacore is head of policy and government affairs for expanding ESOPs. Michael previously served as pensions policy director for the Senate Help Committee, as well as economic policy advisor for Senator Rob Portman. Before his time in government service, he worked at JP Morgan's London office and holds an MBA from the Wharton School at Penn and a BA from Boston College. And finally, Mark Warshawsky, senior fellow in healthcare and retirement policy AEI. He also focuses on Social Security and retirement issues, pensions, long-term care, disability insurance, the federal budget, and healthcare. Before joining AEI, Dr. Warshawsky served as Deputy Commissioner for Retirement and Disability Policy at Social Security Administration. He was my old boss back then, leading the proposed revamp of vocational rules using disability benefit adjudication. Earlier, he served as a member of the Social Security Advisory Board, Vice Chairman of the Federal Commission on Long-Term Care, and Assistant Secretary for Economic Policy at the U.S. Department of Treasury, where he played a key role in the development of the Pension Protection Act of 2006. He has also held senior positions at Towers Watson, the Federal Reserve Board, the IRS, and TIAA-CREF. So I have a few questions here to start with, but any of you watching this webinar are welcome to send questions our way. We'll do our best to include as many as possible, in our discussion. If we miss any, we'll try to follow up with you with answers later on. We want to make sure your questions get answered. Okay, let's get started. In March, the Department of Labor released proposed rules regarding investment alternatives in 401k plans. It created a 6-factor framework for evaluating all investments in a more neutral manner. The draft language surprised some in the policy community who expected wording that more directly permitted alternative investments in 401ks. This language seemed to go beyond that in a way that sort of looked to build a more holistic view around investment choices in general. However, some in the policy community feel that the language did not go far enough in providing safe harbor for innovative providers to provide plans with more investment choices, while others are still concerned about investment risk for plan participants. Mark, I want to start with you. What are your views on the DOL's draft rulemaking, and how do you think they can be improved?
Yeah, thanks for your question, and thanks, David, for organizing today's session. I did offer a comment to the Department of Labor. At a very high level, I think it's an appropriate rule in the sense that these new types of investments, private equity, other types of investments, can be appropriate. They add diversification. They may increase returns, but they're not a panacea. They increase risk. They have less liquidity. And so they need to be very carefully analyzed in the context of a retirement plan and considering, what the particular audience, the plan participants, can tolerate and can understand. So that's really where my critical comments to them, critical in the sense of I think that the regulation needs to be improved in the following way. They, as you mentioned, they did give, I think, 6 characteristics that need to be evaluated: return, risk, et cetera, et cetera. And those are appropriate, but they're sort of the proposed regulation puts them in a almost like in free space. There's no context for that evaluation, and I think that needs to be demanded. In other words, it needs to be evaluated, the new types of investments compared to something, and the comparison should be presumably to the menu of investments that the plan currently has, the 401k or 403b plan currently has, and asking, is the return, additional return, sufficient, to warrant the inclusion of these types of investments? It very well maybe the answer is yes. But also you need to do that type of analysis in order to say, should it be 100% of the portfolio? I think it's very unlikely in most circumstances that should be. So therefore, what is that maximum part of the portfolio that these investments should be representing? And that can only be arrived at by analysis, a comparative analysis. And the regulation did not specify that. In fact, it was quite explicit that it didn't want to do that. But I think it's missing the necessary analysis that's done. I'll mention one other thing. It had a very specific area that it mentioned, which is sort of like a one-off. It mentioned variable annuities as an appropriate investment for the accumulation phase, the retirement phase of a retirement plan. In other words, when the money comes out of the plan. And variable annuities could very well be an appropriate investment in a plan. But there too, it needs to be evaluated compared to something else. It needs to be compared to, for example, immediate annuities. It needs to be compared to withdrawal options, systematic withdrawals. And again, on all these criterion of costs and risk and so on. So there too, again, it's totally appropriate to consider a variable annuity. And it may very well be that it is a good option, but it needs to be evaluated in the context of a broader menu of investments. And that's really my main criticism of the regulation proposed.
Mark, thank you. Michael Davis, how do you feel about the proposed rulemaking? What are your thoughts on it?
Well, first of all, thanks so much, and thanks for saying first and last name with 2 Michaels on the call.
I was trying to figure out how to make that work today, so we'll muddle along.
Right. Well, first, I just want to thank you for hosting. I want to thank National Taxpayers Union for organizing this call. We're excited to be here. I'm really excited to be on with such legends in the retirement space as Mark Warshawsky and Michael Sinacore, both names that I think anybody should know in terms of being leaders and pioneers in retirement. I think they're very important names. And, you mentioned the Pension Protection Act. That set this whole QDIA conversation in motion around what a qualified default investment alternative is all about. I think, in my personal opinion, that was one of the most important pieces of legislation in the canon of American retirement. So thank you, Mark, for being on. It's great to see you in person. With respect to the rule, I have a lot of history with these types of assets because when I started out at JP Morgan, I was working with a lot of large plan sponsors, primarily defined benefit plan sponsors, large managers of university endowments. In many cases, they use these types of investments to increase returns of overall portfolio, diversify risk. And just to be really clear in terms of the categories of private assets that I think most people are thinking of in this context, it's direct real estate, it's private credit, and it's private equity. They used those assets to great effect in a lot of cases. They were very sophisticated plan sponsors who are making those decisions. I think it is a bit of a different proposition when you're talking about these assets in the context of retail investors. We know from many, many studies that have been done on the level of financial literacy that the average American has. Many of them don't fully appreciate the difference between stocks and bonds, let alone something a little bit more complicated like private assets. So I do think the threshold of care needs to be a little bit more thorough, and I think the threshold of transparency needs to be a lot more well considered and broad in this context. So in that context, as I look at the rule, having been at the Labor Department, I can appreciate all the work they did on it. I thought they did a very thoughtful job. They did some of that was very principles based. There was a lot of debate about whether the rule would be asset neutral or not. What that means is that the department should not tip the scale to say that one asset class should be treated one way versus another. So if you look at even the title of the rule, they don't mention private assets or alternative assets, even in the title, right? So it's meant to be more broad, and I want to commend them on that. I also do think that there are elements of improvement and work they can do to make the rule even better. And, as somebody who has looked through these comments in the past, I was at the department when we were working on the fiduciary rule, and there was a lot of conversation around target dates at the time. What would happen is that the staff would summarize the comments, right? So they would read all the comments, summarize them, and put the major themes in front of us as leaders to help sort of adjudicate what we wanted to do. But I would always want to go a step further. I would always want to read those that were strongest in favor, those that were most against. And I do that even with this rule. There are thousands of comments submitted on this rule, by the way. And just looking at some of the comments, if you look at some of the consumer groups, they were concerned around things like transparency. They were concerned around things like just the complexity of these investments. I would tell you that as someone who's been in the market for a long time, I would not advocate that these investments are standalone in anybody's 401k plan. I think they are better deployed in a multi-asset portfolio where you have a broader manager who's managing a broader pool of assets. So there were concerns around those kinds of things. On the other side, people were commenting on the use of examples. And so to make the rule asset neutral, there weren't sort of these, clear defining advocations in the rule about the use of these assets. What they did is they said, well, here's a broad principle. Now let's use an example. And that example almost always was with respect to the use of private assets. I do think that the use of examples can make things more clear. But they put the examples actually in the rule and not the preamble. I think that's a challenge because a lot of people are going to use those examples as a rule itself and operate only within the four corners of those examples rather than using those examples as an example, as an idea of what to do. So I do think that, in my opinion, the example should be moved into the preamble, and it should be made very, very clear that those examples are not the defining way you can use these assets. There's a broader way you can think about them, and the rules and the examples are only meant to be illustrations and not defining in terms of the way the rule would actually operate.
No, that's a great point. Thank you, Michael Davis. Michael Sinacore, I want to give you a chance to respond to answer this question, but then I wanted to direct the next question towards you first. So why don't you start with if you have any comments on this one?
And listen, it's a huge honor to be on the panel with Michael and Mark. As you mentioned, my previous job, I was pensions policy director at HELP when I worked for Senator Portman on Secure 2.0, and these are two of the people that I relied on most to make sure we have the right data so we can make the right decisions. And I think that is, kind of the point you made, Dave, in the beginning. It's one of the things that makes the retirement committee so special is that it's a really collaborative environment. Everyone here is here for the right reasons. And, what I would focus on the rule here is, for me, as someone who cares about the ESOP world, and the ESOPs have historically been targeted by Department of Labor for lawsuits and stuff, we think unfairly. And what the rules signal to me is that, regardless if one agrees with it, one thinks it's perfect or not, I mean, I doubt anything is perfect. It signals a Department of Labor that is seeing the retirement regulated community as an ally, a group of people who are trying to advocate and provide a secure retirement for Americans, rather than a group that always is doing stuff wrong. And so that's just something I've been very encouraged about when I read the rule. It was clearly Assistant Secretary Aronowitz and his very capable team over there have really thought through these issues, have made some good considerations, and my understanding is they've been very open to, hey, let's make this as good, as strong as a rule as we can make, and have been very open to feedback. So I think from our perspective, that's a breath of fresh air at the Department of Labor right now.
Michael Sinacore, thank you. So I'm going to direct the next question towards you. And then, by the way, anyone's welcome to submit questions. So I still have a couple here I want to go through first, but then I'm going to look towards the list over here. So please, add some, and we'll take a look at them. So Michael Sinacore, the Secure 2.0 Act was passed by Congress in December 2022. This bipartisan bill contained a number of provisions that expanded options while improving retirement security for Americans, including creating a tax credit for employers to start new plans, requiring automatic enrollment for plans, allowing for emergency withdrawals for emergencies, increasing catch-up limits, and creating a new savers match. Some policymakers are wondering how implementation of this bill is coming along, and particularly with including the savers match. So there's a lot of interest in the savers match. The match is targeted towards low-income Americans, providing a federal match of up to 50% of a saver's contribution into an eligible retirement account. What's your view of how 2.0 is coming along? And if you have any specific thoughts about the savers match, we've been asked to about it.
Well, so listen, it never is implemented as quickly as you want, but we'd rather have it be implemented correctly than implemented quickly. And if you remember, like, just to get Secure 2.0 passed, that was a two Congress exercise after a two Congress exercise on Secure 1, and some of these ideas really go back to the 90s even. So I mean, we like to see it be done quickly, but obviously we gave Congress, we as in Congress gave, where I was at the time, gave the administrations a lot to do. And so, yeah, not as quickly as we'd like. The savers match, I think, is what's going to be most exciting, because I think that's going to put money in the hands of ordinary people. I think it's really interesting to see that the issue that I think the administration's glommed onto, which I think is interesting, is the education aspect, right? Having a website where people can find products in which they can put their savers match. I think that's what's really exciting. The thing that I think we often ignore in Secure 2.0 and in retirement policy in general is how we've historically relied on the tax code to provide retirement policy. You look at the savers match, the tax exclusion for 401ks, and those are all wonderful things. But what we started doing in the last decade, though, is realizing that sometimes it's kind of taking the work of Richard Thaler, who said that humans are not always the most rational people, right? They respond to nudges. I used to tell a story that when I was in Stockholm, I made my friends come with me to the Nobel Prize Museum because they had a Richard Thaler exhibit and actually mentioned Secure 2.0, and they all punished me later by taking me to the ABBA Museum. But I mean, that's
the sort of trip I would take on it. That's the sort of visit I would take on a trip to irritate my friends. Yeah.
Exactly. But what's interesting is that what I think it's exciting about Secure 2.0 is we built on a lot of stuff in Secure 1, which said, hey, the tax, letting people keep more of their own money is, to invest in retirement is wonderful. We are completely supportive of that, et cetera. But I think the other side that we need to think about is also, like, what is the nudges we can do? Which are often more tax efficient from the position of the federal government. That's auto enrollment, auto re-enrollment, educating people about how the savers match works. So I think that's what I find the most exciting as well. It's not just the tax provisions, but the other things, and they work in tandem. And obviously, the sooner we get those rules out, the sooner we clarify auto enrollment, the better for everybody.
Great, thank you, Michael Sinacore. So Michael Davis, I'm going to go to you next, and then Mark, you're going to be on tap after that. So I'm going to feel free to go back and talk about 2.0, but I want to move to the 3.0 question for you, so you can sort of talk about both. There are rumors going around that there's a new bipartisan Secure 3.0 that could be in the works. These rumors may be coming from downtowns. I'm not sure how much of this is actually coming from Capitol Hill. But there are provisions that are being talked about that include, auto RA mandate for small businesses, broader annuity integrations, expanding startup credits to nonprofits, lowering required coverage age from 21 to 18, more flexible safe harbors. What would you like to see in a Secure 3.0 if one were to actually happen? And what was missed in 2.0, or what would you like to see in a bill that could come around at some point, maybe the next Congress?
Yeah, well, I think those rumors are real. Certainly I think people are talking about it. And we used to do something when I was at TIRO, we called it Capitol Hill Week, where we would go up to Capitol Hill and speak with all the committees of jurisdiction on retirement. And certainly people are talking about it. I think there is some level of fatigue, though, with Secure as a artifice to sort of brand it, right? So I think people want to move on to a new brand. If they call it something new, perhaps maybe it gets even more momentum. But I think there are some big ideas.
Even more secure.
But, and I'm not good. Michael Sinacore is probably the best at that on this call. Maybe he can come up with a great new acronym. But I do think that there are these provisions that people do talk about. And I could not agree with Michael more that I think auto provisions are the most important way to sort of move a society to a desired outcome the fastest. And I think the data is very clear on this. And again, going back to PPA, you look at what happened post PPA in terms of the diversification of the average American family into equity and beyond just sort of cash savings, what it did for the individuals that were more diversified by getting into these either balanced funds or target date products. It made a big difference. And I do think that auto enrollment, the other piece I would mention, Michael didn't mention this, but I'm sure it was on his mind, auto escalation. So if you get people in at sort of a deferral of 3%, the data would suggest that they stay at 3% unless you escalate them. So I think that auto escalation, auto re-enrollment, auto escalation, I think those features are very key. Another thing I would mention, and we didn't talk about this, but I think is an important element, is there's been a lot of talk on Capitol Hill about the fact that 403B plans, and these are plans that typically are available for healthcare workers or education workers, are not eligible to go into collective investment trusts. They can only go into separate accounts and mutual funds. A lot of people, maybe a lot of people on this call do understand what CITs are, but just for the uninformed, they're another form of sort of a aggregated structure that's more flexible, that's typically lower cost. Corporate plans have been using them for a long time without any issues. This provision has been floated, passed by the House, not by the Senate. I would strongly encourage Congress to include a provision to enable these plans to access CITs. I think they've been wanting it, and certainly I think it would give them more flexibility and likely lower costs across the board.
All right. Thank you, Michael Davis. Mark, I want to throw this to you if you want to talk a little bit about what you'd like to see in a 3.0 or what was 2.0, 3.0.
Sure.
And I'm going to direct the next question your way after this.
Okay, thank you. So, as one of my issues is retirement income, and certainly in the movement from defined benefit plans, which always gave a lifetime income to the plan participant, to 401k plans, we certainly lost that. And so I think over the years, Congress and the policymakers have been trying to recreate that to some extent. Within the context of this new vehicle of a 401k, 403b, basically individual retirement account. So they've removed barriers, they've provided more information, disclosures in the pension statement and the retirement plan statement. In Secure 2.0, they added a provision which was basically leveling the tax playing field. I think Michael Sinacore mentioned that that there's a lot of tax provisions in the law, and this was one of them. Before Secure 2.0, partial annuitization strategies, in other words, where you take some money out through an annuity and some money that is taken out through systematic withdrawals, basically because of the required minimum distribution rules, was at a disadvantage. Basically, the plan participant basically had to pay more in taxes on that strategy, even though, because generally a life annuity gives you more income than a systematic withdrawal. Even though it's desirable because it provides more security. Your money lasts longer for as long as you live, and it's less volatile. So in Secure 2.0, they amended the minimum distribution requirements such that for the annuity income, you get a credit. You get a credit for it towards the minimum required distributions. So I think that's a good thing. It'll be interesting to see how much that is used, and basically encourages these partial annuitization strategies, which leads me to your question about Secure 3.0. So, along with, we've talked a lot about sort of defaults and automatic this and that. Nothing is mandatory, but it is sort of suggested by policymakers because we think it's a good thing. I think in this area, also in the retirement income area, I think it's a reasonable question that I'm not sure I know the right design, but I think some notion of default to some aspect of annuitization in a retirement plan is appropriate. And so again, it's not a tax expenditure, it's using the default mechanism. And again, it needs to be very carefully thought through because annuities are permanent, you can't go back. Once you select it, it's pretty much automatic going forward. But on the other hand, that's its advantage is that it provides the security and the basic level security that in retirement for the remainder of life that is basically one of the purposes of a retirement plan. So I think opening that up in Secure 3.0 I think would be an appropriate area moving this forward.
Great. Thank you, Mark. Okay, so I'm going to send the next question to you, and then we'll go around a little bit on it. The Trump administration has taken a keen interest in retirement policy. They're implementing I was told to call Trump accounts 530A accounts. So that's the official term for some reason in our office. I don't know, we're very tax oriented. We like to use the numbers. They're created by the Working Families Tax Cuts last year. The accounts are provided, the federal government provides seed funding for U.S. citizens under the age of 18 when these accounts are created, and they become IRAs when the individual reaches 18. The administration has also created a Trump IRA marketplace, or is creating it, that aims to connect independent contractors, self-employed individuals, and part-time workers with low-cost accounts that have been vetted by the federal government. On top of all this, they're looking into the Australia Super, or the superannuation, which is Australia's mandatory retirement savings system. The system is a pretty large structure, which we'll probably have a chance to talk about a little bit, where employers are required to contribute at least 12% of their employer's salary into what's called a super account, which goes over time until an employee retires or reaches a certain age. Several states have also created auto IRA programs that automatically enroll workers into retirement accounts with payroll deductions if their employers do not create their own plans. 17 states either have plans or are developing them now, including big government states like Oregon, California, and Illinois. Mark, what's your view of the Trump administration's retirement policy initiatives? Do you see value in the Trump IRA marketplace? Do you see value in the we talked about a European country that you've been looking at in terms of their potential structure. I don't know if that plays into what we're talking about here.
Yeah, so there's a lot being discussed and a lot going on. It's sometimes a little bit they sort of bleed into one another. Even the names are a little confusing. So we have
Yes.
Trump accounts, which are for children, and then Trump IRA, which is for workers, it's for adults. And so that's a little confusing. And then there is a discussion about the Australian retirement system. And I think that's in the context of Social Security changes, Social Security reform. So there is indeed a lot being done and discussed. So let me just sort of pick each one and say a little bit about each one. So with regard to the Trump accounts for children, I think it's a hit. I think it's a good idea, and I think it's well regarded, across the political spectrum, and among the media and others. I think it's a good idea to have these accounts for children, basically to support their young adulthood, their transition into young adulthood, either for education or to buy the first home and so on. And sort of using the IRA chassis was, I think, rather clever. It made it easier to do technically, and the IRA chassis is pretty broad. But I will have 2 points just on that. So one of the points is, in fact, to help people, young people buy a home. The problem with the IRA chassis is that it's limited. It's only up to $20,000, which nowadays is not a lot of money for a down payment of a house. In a lot of areas, I think almost in no areas actually could you get a house with a down payment of 20,000. So I think, to make this account more effective for that purpose, and I think this is law. So maybe this is something that could be done in Secure 3.0. We need to increase that amount. And that's just for IRAs in general, but also I think for the Trump account, because it is on a IRA chassis. Now, with regard to Trump IRA, which is using the Savers Match, which was already was legislated in Secure 2.0, but what the administration is adding is these investment, I guess you could call it a clearinghouse or a website. It's called trumpira.gov. So it's a website which basically will offer investments. They're private sector investments, but they'll be available on this website. I'm of two minds about it. I mean, on the one hand, I understand that they want to sort of make sure this low cost and will accommodate very small accounts, and I appreciate that. On the other hand, there are private sector companies that do this. There is a company called Retirement Clearinghouse, which could have done this. May, in fact, could do this. So it's a little bit of a competition with the private sector. So it's unclear why the government should be in this business. The other area in which I think it's a little sort of not totally internally consistent in these investment accounts, they also include, in addition to the typical equity and bond type investments, they also say they include principal protection funds. Basically money market funds. And I don't understand that. That's really not generally a good investment for a long-term retirement account. So I'm not sure why they're including that. So there's a little bit of a criticism. Now, with regard to Australia, it's a good system. I've been studying it quite a bit lately, and I'm very impressed because it is balanced. It's financially sound, which is a very big deal. It's not going bust at any time soon. It's very popular and has a nice balance. It basically is investment accounts, very large ones, but it's backstopped by a defined benefit default in the sense of if you don't have assets, you can fall back on it. So if you do have assets, you don't get anything from that. So it's a safety net as opposed to an addition. Which I think is a clever idea. The challenge for the United States to move to that system is we have Social Security, which has been marketed, and this goes back to President Roosevelt, as you put the money in, you're entitled to the money to come out. Now, in Australia, that is not true. You're not entitled to the money only if you don't have other assets. So it would be a big transition to move from our system to the Australian system. I'm not saying it couldn't be done, and it may even be worthwhile doing, but politically, that is challenging. I mean, Congress could just say tomorrow, this is true because of a 1960 Supreme Court decision. Congress can change Social Security benefits at the drop of a hat. There's under no legal obligation to do anything. The payroll tax is a tax, but politically, it's very challenging to sort of, split it apart. Anyways, a lot to say about all your points.
That's great, Mark. Thank you. And sorry about throwing so much to your way in one question. Michael Davis, I'm going to throw it all your way now.
Well, I do look forward to Michael Sinacore's comments on the politics of Social Security. I'm sure there are no politics that would prevent sort of an easy discussion there. But there was a lot that you packed into your comments. I'll start with the Australia piece. I was in Australia late last year, meeting with a lot of the superannuation funds and regulators, and they're obviously very proud of the system that they built. I think they would say to you that they took the best and left the worst of a lot of the world's retirement systems when they built their own. And we were talking about the importance of auto features. They have really taken that to heart, and and they've been the beneficiaries of it. Also having a mandatory system that sweeps everybody in. I think some of the core elements of that system that I think are benefit them relative to our system is portability. I think that's a really big one, is these superannuation systems are independent of the employer. So you can move from employer to employer and your assets follow you fairly easily. We as a country have not done, in my opinion, a very good job of making assets portable. So you end up with a lot of stranded assets and just the whole process of moving your 401k assets from one employer to another is a lot more complicated than it ever needed to be. And I think, their system has helped address it. I would also say that there are some winds blowing, in my opinion, in the US around the centralization of retirement assets. So, for a long time and for decades, obviously, employers have been the main vehicle through which employment benefits have been delivered. And a lot of that comes out of World War II, and there's a whole history behind that. But if you look at some things like the rise of PEPs, and PEPs are pooled employer plans, for those who don't know, they are a corollary of multiple employer plans, MEPs. A MEP is where you have sort of a system that sort of benefits multiple employers. Typically, one employer is at the center of that as the fiduciary for the assets. With a PEP, a pooled employer plan, you may have a third party like an advisor, a record keeper, another party that's overseeing those assets. Those assets have grown fairly significantly. And what you're starting to see is, particularly the small employer, this interest in having more of a centralized system. That is also, I would argue, the basis of what's happening with these state retirement plans, where, as you said, 17 states. When I was at the Labor Department, there was a whole debate about will those plans be preempted by ERISA. I was certainly an advocate that they should not be, and that's the way they've been developed. But again, you have a system where the state is administering those assets within that state, again, more centralized. I think there is this sort of small and maybe large set of winds that are blowing, but a lot of them are blowing in this direction of having more centralized delivery mechanisms, which is what Australia has done. I don't think those influences are going to dissipate anytime soon. And I think there's something that's really important to watch. Also, I just like to comment on the Trump accounts quickly. I do think those Trump accounts, they have grown fairly significantly. And I think I saw some stat, 6.5 million people have enrolled. I think that is significant. I do think that a lot of people may or may not know that originated as a Democratic idea. So a lot of people thought of those as, I could see Michael Sinacore nodding violently. They originated in a lot of cases as baby bonds. And, kudos to the administration for sort of, coming on and just making this very bipartisan, because I think that there are bipartisan roots with respect to it. And I hope it does have legs, because what it will mean is that, people, kids, babies can start saving for retirement at a very early age. One thing I would encourage the administration to at least think about is package some financial literacy with this program. And I would say particularly at the high school level, because our literacy rates are dramatically low, and that would be very, very helpful. The other thing I would offer is that the country should not underappreciate the operational challenges involved, because with the Trump accounts, you do have this mechanism where you have Treasury directly for those kids born between the years of 2025 and 2028, this $1,000 contribution they can make into the accounts. The operational steps required to make that happen and make it happen smoothly should not be underestimated. And there was a great comment letter that I thought SPARC is the organization of record keepers in the US, did. It's on their website, sparkinstitute.org, just about those operational issues. I think if those operational issues are thoughtfully administered, it will help not only with the Trump accounts, but also with the Savers Match. Because the Savers Match, I think, has some of those same operational considerations that need to be navigated. Now, that kicks off, I think, plan year 2027. But I do think that this big focus on Trump accounts has probably diminished a little bit of the focus on the implementation of Savers Match. But in both cases, the operational considerations are very, very important.
Michael Sinacore. So I was going to throw it your way for comments here.
It's actually funny. I was thinking about this. So I was first pitched on what we now call Trump accounts when it was called, I think, 401 Kids, which was a Bob Casey idea, a Democrat from Pennsylvania. And it actually, it's funny because it did start as a Democratic idea, but some of the other advocates over time were conservative Republicans. So you had Casey's predecessor was Rick Santorum, one of the most conservative members of the Senate at the time. He supported it at one point. Coburn, who was the only only senator I'm aware of who ever decided to voluntarily get off the finance committee, which is the tax trying committee, supported it. And I forget the original Democrat involved. It has bounced around between the parties, which I think is reflective of just sort of what it's probably a good idea. And I think what it does is uses the magic of what Einstein called the eighth wonder of the universe, compound interest, and lets it rip. And it also, I think, has salutary benefits of people when they have money in an account are interested in interested in what that means, which I think it will help with with financial education. But I think Michael's right. We need to really make sure we're educating people on what this money will do, so it really can be an investment that they can have for the rest of their lives. Something that's interesting is like representing the ESOP community here, which are employee-owned companies. They're owned through a separate account. Those are similarly a gift from your employer that then can grow as your company grows. And we've seen in our own experience there is that companies just by having an account, workers will be really curious about it, be wondering what's going on, become themselves more financially literate. The advantage that those companies have, of course, is that they have HR departments and financial advisors, on staff in many cases who can already help that. So it's not an issue that exists with the Trump accounts, but I think it's a really exciting thing here. And I think what it makes me wonder though, and is that if you look at a lot of retirement policy, it's based on having people save later in life, right? We do catch-up contributions, for middle to end career workers, and that makes sense, right? They're at their peak earning years. That's when they can save more. You really want to encourage that. But I think when I was in Congress, I almost wish we could have done more stuff on the earlier side, so we get more of that tax, that compound interest savings there. So I think it's really exciting. I have a bunch of friends who volunteer at these tax clinics in low-income neighborhoods, and they've been saying anecdotally the take-up rate has been enormous, and it's really gotten people involved. And the other thing I think that just something I think of as just as an American citizen is just being rooted and connected in community. We have, if you look at American politics on both sides of the aisle, there's a clear sense that people feel left behind, that they're not mattering, that they don't have investments. And we see that capital is growing so much faster than income. So giving people a stake in capital allows them not only to see become wealthier, have investments, which is great, but also makes them feel like they have a stake in the American economy and the American community, which I think is a great way for us to make people who feel forgotten feel less forgotten, which is just a really good. We see the psychological and sociological benefits of that. So I give kudos to the people on both sides of the aisle who worked on this for probably about 30, 40 years, right, Michael? It's been a while. And, but the last thing I'd say on that is it's also we need to sometimes show patience. Sometimes, it takes a while for a good idea to come. And several senators on both sides of the aisle, and House members get a lot of credit for that. And if there's someone on the line here whose boss I ignored, I should say Ted Cruz was involved in the last push. I apologize, but it was really a really great teamwork across the aisle, and it was a really great victory for the American people.
Great. Thank you, Michael Sinacore. I wanted to take our discussion to more of a conceptual level. Taxpayers provide significant subsidies to retirement accounts. However, there are still issues with access to plans for many Americans. Our system's pretty complicated, both for those earlier in their careers and those nearing retirement. Even late career workers who do everything right and save for retirement can be confused by the options ahead of them as they near the end of their careers. Mark, I want to direct this question to you, if that's okay. Do Americans have enough information about how to save for retirement? What is the appropriate role for the government in encouraging retirement security?
Yeah, thank you. I mean, there is a lot of information, but it's comes from different sources, and so it's not really one voice. Certainly employers that do sponsor plans, retirement plans, certainly pension plans, but also even retirement plans do provide a lot of information. Financial organizations, institutions like where Michael Davis used to work, T. Rowe Price and his competitors provide a lot of good information, and insurance companies and others as well. With regard to the government, I think there is definitely a role. I'll mention one very narrow point, which actually goes to the very beginning of our discussion about the proposed rule on alternative investments that the Department of Labor has put forward. So I think right there's a role for the government to insist that, for example, if these new investments are included in the plan menu, that there be adequate disclosure adequate information and education that these investments, do represent a different type of risk, a return profile, and in particular, they represent a different liquidity profile. They're generally less liquid than other investments. And so that's very important that the potential investor in the retirement plan understand that. And that is the role of government to make sure that that is adequately explained. At the more conceptual level, but really at the more higher level, and invoking some other countries, this is a long time ago. When I was at Treasury, I took we'll call it a field trip to Sweden. They also have a Social Security retirement system, which they're very proud of. And it was designed pretty much from the ground up. And one aspect of it is they combine the retirement projected benefits from their Social Security with the retirement benefits from pension plans, from retirement plans, from employer plans. This is a cool idea, and it's doable. They do it, and they've been doing it for 20 plus years. And now in the United States, maybe at one time it would have been technologically difficult, but I think it is doable, and I think it would be an appropriate goal. I don't know if we could do it in Secure 3.0, maybe basically to direct the Department of Labor, the Social Security Administration to join forces to say, let's get all this information about a person's retirement resources, whatever they are, wherever they are. I don't know if it can include IRAs, maybe that's a bridge too far, but at the very least, more formal retirement assets, but from Social Security and from employer plans. Let's combine that information together and present a statement, that's available, just like the Social Security Administration provides an annual statement online, and employers provide quarterly statements. I think combining them would be a very important educational tool. And that's something that I think would be a worthwhile goal.
Thank you, Mark. Michael Davis, feel free to, I'm going to ask you the next question, but you can also jump back to the last one that I asked Mark. With the federal debt currently at over $39 trillion and increasing by $7 billion a day, taxpayers expect that federal subsidies to encourage retirement security are well designed and also encourage economic growth. What are we doing right? What can be improved?
That's a tough question. I appreciate that.
I saved you the best.
I appreciate that for the very end. I'm not going to get into federal debt conversations. Obviously, a lot of that is happening on the Hill. I will say that I do think that subsidies with respect to retirement are very important, and we should continue that. I think they have proven to be effective. They have proven to help people be a lot more financially sufficient than they otherwise would be. There's often a debate when you're talking about more auto features that these features do cost Treasury because you have more people that are having money come out on a tax deferred basis. But I guess I would encourage the policymakers to understand, with the aging that has happened, not only in our country, but in other countries around the world, this policy around how we deal with our aged citizens is really, really critical. And I can tell you that, the UK is dealing with this, Australia is dealing with this. And I just think that's really critical. And obviously, there are some pretty charged conversations that have to happen with respect to Social Security and the role it has to play. But I am a fan of the three-stooled approach where Social Security is a very important safety net and should be protected. And then also with respect to people's personal savings, we should continue to offer tax benefits to encourage people to save on their own and to do the best they can with it. I think Trump accounts will help that, again, starting from birth. But I think as you think about sort of employee-based savings, again, more auto features, I think, are absolutely critical to make that all work. I do also want to just go back and just comment. Mark was talking about financial literacy and education. I couldn't agree more with that. I do have some fairly controversial views on it, but I will say that I think because the level of financial literacy is so low in the country, even when you provide a lot of disclosure to individuals, I'm not sure they read them. I'm not sure they understand them. I'm not sure they understand the terms. And the more disclosure you put out there, I think the studies would say people almost get overwhelmed. And I think about financial information the same way I think about medical information. If you're not trained to consume that information, it's very hard to discern. I do think that when the providers are asked and required to provide information to individuals, I think that's a much more important influence, because when a provider is having to do it, one, they have to understand it themselves to actually issue it. So when I go back to the disclosure regs for 408B2 and 404A5, when the Department of Labor said, well, U.S. providers, you have to disclose your fees and it has to be clear. I think that having the providers do it and the rules that govern that were much more important. So I do think with respect to the alternatives rule, I think there should be some sort of prescribed disclosure document that the department has around how the disclosure is going to work for individuals. But I think the best part of that is the providers that have to provide it. That will make a big difference, I think, in terms of their understanding of it and then making the information as clear and as actionable as it can be for the average individual.
Thank you, Michael Davis. Michael Sinacore, by the way, we got one question that's come in so far. This is your chance to ask questions for those watching, but we'll get to that question in a second. Michael Sinacore, if you want to comment on this question.
Yeah, no, I think that's I think I think I agree with everything Michael said, which is not unusual, which is why I always enjoyed when he lobbied me, because it was like I could just say yes to almost everything. You know, or if it was no, it was like, oh, this is not really quite in my realm, but like, you know, fine. So the thing I would just add to that is that we have a growing gig economy workforce and a growing people who are self-employed. And how do we reach to them? I don't have any solutions. If I can make a plug for my old boss, Bill Cassidy has a white paper on this that's really good and discusses that. And the other thing is, how do we get these people to feel like they're trusted? Whenever I go to these things with gig economy workers, they'd always tell me, you know, when I worked at a company, I could trust my HR department, I could trust them, but like, you know, I may be talking to Uber and Lyft in a day, I have my own housekeeping business, whatever. How do I actually get that trust? And so I don't have any solutions to that personally, but I think it's something we need to consider because that is the reality of the economy going forward, right? And it's not, and it, you know, one things when I talk, like we talked about PEPs earlier, I remember I was talking with one of the gig economy companies about it, and they were like, "We'd love to offer this, but we then break the contractor model, right? So how do we fix that?" So just something to put out there. Obviously, I think that. I also think that one of the things that we can do here is give people a bigger stake in the places they work. I think that's something that really is going to drive our economy going forward. We're seeing Americans are becoming, as we see with the gig economy, increasingly entrepreneurial. So that one of the reasons I was excited to join, leave government and join expanding ESOPs is that there's now this movement in the United States for companies to give more benefits to workers who work hard, to give them stakes in their own businesses. And I think that's something that is really an exciting opportunity for us going forward. You know, and I think that's something that would, you know, that we have an opportunity for. It's bipartisan. It's, you know, and it's actually like one of the things that we've seen is to tone down the temperature right now. I think next year we're going to a very divided Congress, whether Republicans or Democrats hold either body, it's going to be pretty narrow each way. And we found that that's when retirement gets done. If you look at when Secure 1 got done, Secure 2, it was in narrowly divided Congresses because in the end, right, like members have to go home and bring things to their constituents they want on. And in narrowly divided Congresses, not much partisan stuff can get done. So this is, I think it's an exciting time. I think this conversation is very timely.
Okay, so we just got one came in. Here, I'm gonna read it. Secure 2.0 expanded the tax incentives for small employers to begin offering retirement plans. We know that workers of small employers have less access to retirement plan. While the effects of Secure 2.0 remain to be seen, how else can we help encourage small employers to offer plans? Anyone, you guys want to take this one on? Michael Davis.
Yeah, I think, and you know, I'd certainly love to hear from Michael Sinacore because I'm sure you heard from a lot of small employers that they were debating Secure. But I do think that from the conversations I've had, certainly when I was in the department and since, one of the biggest issues that small employers have is administrative. They may not have someone who's fully dedicated to running a plan. That person may be the CFO and the treasurer and running the HR plan. So they're doing a lot of things. And so I think the most important things that can be done for small employers is to make the administrative element easy. And I told you that I was involved in this conversation around whether the state-run plan schemes would be preempted by ERISA. You know, and there was a big debate about that because I think a lot of people certainly would have wanted those plans to be covered by ERISA. But there are a lot of employers, particularly small employers, that talked about the compliance issues that they had with ERISA and the filing requirements, all those things. So I do think that a lot of attention has to be given to the administrative issues. I think PEPs I think that's one place where you see a lot of growth in PEPs. It's from the small business category, where small businesses are saying, look, if I can find a way to, it's important to provide the benefits, but if I can find an administratively easy way to administer it, either through a state-run plan, if I have access to it in the state I'm in, or through a PEP, I think a lot of them are saying, that's what I'd rather do.
Thank you. All right, so we have one other question. This could be our last question. We're getting close to the end of time. So maybe we'll give everyone a chance to answer this question, and if you could sort of tie it into a close, if you'd like. What is the one action the federal government should take to improve retirement rules for all Americans? Mark, I want to start with you.
Well, I know we're not talking about Social Security, but I think that is the answer to the question, is that we need to get a Social Security system which is stable and sustainable, because it is the basis of the whole system. And right now we do not have that. And so I think that is the most important thing. As politically difficult it is, it's not technically difficult. There are been a lot of studies. I've been involved in studying the issue. Many others have as well. But I think that is the one major thing that is needed. I mean, sure, everything else needs to be done that we've talked about around it, but that's the basis of our retirement system in the United States, and it's not a sustainable system. And it relates to the budget as well. You mentioned the $39 trillion in debt, or whatever the number is. I mean, Social Security is definitely a part of that. I actually, in my conclusion remarks, I do want to come back to the question of the deficit and the debt, and the role of retirement system in that. I think it's overestimated, because you score these bills and you have a 10-year score. Retirement provisions usually are scored as costly, but that's only because it's over 10 years. Usually you get the money back when people retire, because they have to pay taxes on the income. So it's a bit of an overestimate, in the context of the deficit and debt. I think a much bigger area is healthcare, where you don't get the money back, and the need for more healthcare is very dubious. Whereas our retirement system, I think, again, it certainly can be improved, and we need to put Social Security on a sustainable basis. But overall, the architecture is pretty good.
Great. Thank you, Mark. Michael Sinacore, I'll go to New York's.
I think what I always say is that, and this is something that Rob Portman used to say to me when I used to work for him, is that the way you saw, one of the way, I think Mark's right. How we technically fix Social Security, very easy. Politically, not so much. But I think the way you do it is if people feel like they have a lot of savings elsewhere, they're more amenable to fixing Social Security. So I think that what Rob Portman used to say to me is that the road to Social Security reform actually runs through the 401k. So if people feel like they have enough money there, they're going to be more, the politics of changing that go away. So I just always say is that, kind of like what I was saying earlier about some of these ideas take a while to get through. Some of it's also is planting the garden that allows for future reforms, right? And that can often take time. So we've look at the history of ERISA. It's rife with that, right? It was the original Studebaker bankruptcy was in 1955, I think, and ERISA didn't pass until 1974. So it sometimes takes a while to get these ideas right. But when people saw that they were going to lose their savings, it's suddenly we have a retirement. We created a lot of retirement protections. I think that's sort of what's going to need to happen here. People need to see that if we don't make reforms, people will get less money, but they'll be more comfortable. But if we give them more money, they'll be more comfortable with that. So those are things I think about a lot when we come to this. And I think it's also about financial education, right? And this is where having better 401ks, better ESOPs, IRAs, PEPs, et cetera, the Trump account, that allows people to become self-taught in financial issues, which makes the education of the citizens, which are going to need to sign off on these changes through their voting representatives, a little bit easier. So those are just sort of things that I thought about a lot when I was in my old job.
Thank you, Michael Sinacore. Michael Davis.
Really quick, I see we have 1 minute left. So first, I would just double down on what Mark said with respect to Social Security. I think it's really important to protect that program, and hopefully we can work through the politics to do that. Two, in terms of rules that would make the most important difference, I think defaults by far are the most important thing that any system can do, and the more defaults, the better. The state auto IRA plans are a offshoot of what was originally a federal auto IRA proposal that came out in the Obama administration. They couldn't get it through Congress, but I'm hoping that over time, there is more of a federal mandate to do this for people who don't have access. The last thing I would say is process. So rulemaking process, I think, has been debated. I think going back to the original alternatives rule, there's a perception that some have said that the department is only listening to one industry when it comes to making that rule. I encourage them to open up the dialogue to talk to all sides on this. That will make for a better rule that's more defensible in court over time. And I think more plan sponsors will feel better about it. So just in general, I think from a rulemaking standpoint, make sure that you have a process that's really reliable, robust, and transparent.
Well, Mark, Michael, and Michael, thank you very much for this was a great panel. I enjoyed talking to you guys for an hour. This was a lot of fun. For anyone who's listening, this will be posted to our website. And if you have follow-up questions, please feel free to reach out to me or to any of the panelists. We'd love to respond to you and work with you to get your questions answered. And to those on the Hill, good luck surviving the end of session. You guys are going crazy right now, and have a good summer. Thank you very much. Have a good day.